FX strategy at RBC, and she joins me now from London. Thanks so much for weighing in here. The U.S. dollar strength underpinning many financial shocks that we see right now around the world. Why has it strengthened so much, and can we expect it to continue?
So I think it's a combination of factors, but you touched on a few of them right there. The fact that the Federal Reserve is raising interest rates, the fact that the US economy is actually cyclically a lot stronger than the rest of the world, particularly Europe. The fact that if you look at energy prices in particular, gas prices in Europe have been skyrocketing. And so even though gas prices in the US are rising, it's nowhere near as much as they're rising in Europe. And I think you put all that together and it creates this perfect storm, if you will, for dollar strength, which is clearly creating the downward pressure on the euro as well.
And I want to talk about the euro for a second, but then I want to get to the global implications. In terms of the euro, we're basically even now. Do you expect that, I've seen some analysts say that the euro could even go to 92, 93 against a dollar?
It's not unreasonable. We actually started the year expecting the euro to trade at parity against the dollar. And that was before the invasion of Ukraine. It was before a lot of the turbulence we've seen in energy markets. So given what we're seeing at the moment, it's not at all unreasonable that the euro would trade that weekly. Of course, investors are heavily positioned. A lot of people are very long of US dollars and short euros. It wouldn't take a lot of good news for the euro area to prompt a rally in the euro. But as things stand at the moment, our call is for us to break parity and trade down to those kind of 90-something levels.
Wow, incredible when you think about when it launched at parity so long ago. How does that U.S. dollar strength, though, deepen the financial crisis that we're already seeing in developing countries? Are we at a dangerous tipping point here with a lot of those vulnerable currencies right around the world?
Yes, I think what we're seeing is quite idiosyncratic in that we've seen emerging market crises before where there was a lot of borrowing in foreign currency, mainly dollars, and then it came to pay it back. The dollar was strengthening. It made it very, very hard. Now I think emerging markets have been a little bit more selective. There are certainly those out there that have been borrowing in foreign currency. They're coming under a lot of pressure. But the other thing that's creating a lot of pressure is this inflation, energy price inflation, food price inflation. It creates a lot of political pressure as well. We're seeing that play out really extremely in some areas of the world.
Yeah, absolutely. When we talk about the global impact here, even some in the United States do not like the strong dollar. When we talk about things like the Fed, it doesn't have much room to maneuver, as you said, just given the scope of inflation right now. Central bank coordination, it's certainly, we saw it during the 2008 financial crisis, of course, during the pandemic. But are we really equipped to see any of that if we do have a currency crisis here? At this point, we'd be more likely to see some type of a currency war, right?
So what's really interesting about the current environment is we've gone from a world where every central bank wanted to weaken their currency or favored a weaker currency to one where actually having a strong currency is a benefit because you reduce some of those imported inflationary pressures. In that regard, the US is actually in a pretty sweet spot. It may not feel like it at the moment. It certainly creates a lot of problems in the rest of the world. But at the very least, it doesn't mean you're importing inflation the way a lot of other countries are doing at the moment. I think when it comes to the central bank reaction function, they are in a very difficult position. We've not been in this environment before where central banks have both weakening equity markets, weakening economies, and also high inflation. But for a lot of these central banks, their primary mandate is inflation. And I do think that means they will hike further and faster, even than some markets expect at the moment.
Yeah, which means more pain for everyone else. But I hear you. Their main goal is to keep inflation down. We've gotten through a lot. I appreciate it. Appreciate your time. Thanks so much.